The spreadsheet has been open for 11 hours. The model is supposed to hold. You work at a regional firm in Oslo. $4.2 billion. Nobody knows your name. Tonight, you stress test the fixed income sleeve against a 150 basis point rate shock. You have run this exact test 47 times. Tonight is number 48. At 11:48 p.m., it does not hold. Something is very wrong. The error is not yours. A senior manager named Ericsson overrode a duration constraint. He buried it inside a cell formatted to display as 0. 3 weeks hidden. $340 million notional. Leveraged exposure to long-dated Norwegian krone debt. The swaps assumed flat volatility forever. The hedge was decorative, completely useless. Then the Norges Bank drops a surprise statement. An aggressive hiking path. The mark-to-market loss hits $61 million, and it is still moving. You do not sleep. You open a blank sheet and build a second model. The second model confirms the first. You build a third. All three agree. At 2:15 a.m., you compose an encrypted message to your compliance officer. You press send before you can find a reason not to. The message goes. By 7 a.m., compliance has escalated directly to the board. The building shifts. By noon, external auditors are in the building, asking for files nobody prepared. Ericsson is placed on administrative leave. Nobody on the floor makes eye contact. The position unwinds at 47 million loss, not 61. The market moved your way. What they remember is that you found it. You sent the message at 2:15. 3 weeks pass. Ericsson is gone. You return to your desk. Then your phone rings. The man on the line is named Håkon Vesterås. He has never worked anywhere small. He works for the Government Petroleum Fund. $1.4 trillion under management. It owns 1.5% of every publicly listed company on Earth. He tells you there is an opening in quantitative risk. He says it like nothing. He tells you to think about it over the weekend. That tells you everything. You start on a Monday in January. New building, new badge, different numbers entirely. Your badge reads, Analyst, Quantitative Risk. For 8 months, you are precisely that. You build factor models. You decompose portfolio variance. You never touch the controls. $800 million decisions are made in the same tone as choosing lunch. The numbers do not feel real yet. 800 million sounds like someone else's problem. What changes you first is not the size, it is the patience. This fund absorbs. It does not react to earnings misses or analyst downgrades. It simply holds. The fund is so large that panic selling would move the market. Panic was removed. You learn what genuine capital permanence looks like. Fear was structurally eliminated here. 8 months in, you are still a function, but you are understanding the machine. You learn slowly, then all at once. The way you always learn what matters. It is not fearlessness that makes this place different. Fear never had a structure here. Markets open, markets close. Crises flare and fade. The fund does not blink. You are still an analyst, but something in how you see money has permanently changed. By year 3, you are no longer an analyst. The title changes. So does everything else. You are in the room when allocations are decided. Not at the table, not yet. You see how decisions are actually reached. Nothing like what you studied in graduate school. It is political. Every number has a relationship behind it. Every relationship has a history. The head of equity is a Finnish woman named Päivi Lahti. She controls $620 billion. She operates through intellectual rigor and an absolute willingness to make superiors uncomfortable. She killed a $2.1 billion infrastructure allocation. Alone. In 40 seconds. Nobody argued. The counterparty model was built by the consultant who destroyed a Dutch pension fund in 2019. She remembered everything, every failure, every model, dating back further than anyone in the room. You start building your own archive. Every deal, every consultant, every risk model, indexed. 3 notebooks in 3 months. Every observation, everything the institution forgot, you remembered. You keep the things nobody asked you to keep, the things that only live in context. After 6 months in that room, you are a fundamentally different kind of analyst. You cross-reference 7 years of fund records. You find patterns nobody had cataloged. You find names nobody was watching anymore. The archive grows. The pattern becomes clear. Then, one afternoon, Pivy asks you a question directly, in front of the full room. You answer from memory, from the archive, from notes nobody asked you to take. Pivy nods once, returns to her papers. In this room, one nod is everything. After that, the room looks different. The table you are not at feels closer. You remember everything after that. The fund, the names, the history, all yours. Year 5. Portfolio Strategist, Real Assets. You are no longer watching the table. The real asset sleeve is $74 billion. Infrastructure, real estate, timberland, unlisted equity. These are not trades in the traditional sense. You are acquiring structural positions. You take a 40% equity stake in a Chilean desalination consortium, water infrastructure. You take a ground lease on the Rotterdam Port Logistics Complex, decades of duration. You become a cornerstone investor in a Kenyan renewable energy developer. The Kenyan position will represent 18% of Kenya's national grid by 2031. You expected to feel powerful. Instead, you feel implicated. That is new. Power at this scale does not feel like power. It feels like a permanent obligation. On a Sunday morning, the Chilean consortium raises water prices. An NGO publishes a report. The report connects the price increase directly to foreign ownership. You read every word. Back at your desk, you model the reputational risk, then the regulatory risk, then the replacement cost. The replacement cost of the position is $2.3 billion. That is the number that decides. You recommend a $14 million community investment program. The fund approves it. It is not idealism. It is risk management. You are uncertain which is more honest. The ideology you arrived with has been replaced by calibration. Quieter, more durable. Every position you hold affects someone. Most of them will never know your name. You manage $74 billion with the same discipline you used on 4.2. Scale changes nothing. The instrument is different. The underlying question is identical. What is the real risk here? Year 5 closes. You are at the table. You are also inside every system you touch. Year 8. The call does not come from inside the fund. It comes from the ministry. Minister Solberg offers you Deputy CIO. She says it like a question. It is not. You accept knowing sleep will never be fully restored. That is also not a question. The CIO is a Dane named Thorvald. One of 3 or 4 people at this level is alive. You study him the way you once studied spreadsheets. Patterns, tolerances, blind spots. Capital at this scale moves through relationships, not through markets. That is the first lesson. You sit across from a global bank CFO, restructuring $90 billion in Tier 1 capital. You extract board observer rights, fee transparency, and the most aggressive ESG covenant ever inserted. Their stock rises 4% on anchor investor rumors before a single word is spoken publicly. You manage the $1.4 trillion liquidity framework. Every assumption, every correlation, every scenario. Thorvald makes decisions you cannot yet fully follow. You file them. You will understand later. Sleep becomes a managed resource. You schedule it the way you schedule currency hedges. Your personal calls decrease. Your marriage compresses to logistics. You notice both. At this level, personal cost is not accidental. It is structural. You accepted it implicitly. You sign a $2.2 billion allocation in 5 minutes. A billion is now a unit of measure. The scale has stopped feeling abstract. That is the most dangerous transition of all. You learn Thorvald's decision latency. How long before he moves? What makes him slow down? You are running the machine now, not watching it, not studying it, running it. Power at this level is indistinguishable from responsibility. They arrive as a single object. Year 8 closes. Thorvald tells you something he has never told anyone in this building. Thorvald gives 18 months' notice. Nobody outside this floor will know for 6 months. The external candidate list is long. You watch it get crossed out, name by name. The confirmation arrives in a 4-minute call from Minister Solberg. 4 minutes. You are now CIO. You control more capital than the GDP of most countries on Earth. You are 41 years old. There are 12 missed calls on your personal phone. Power does not arrive as freedom. It arrives as a narrowing of what is possible. Every conference appearance, every published letter, every AGM vote is parsed globally. You stop attending conferences. The signal you send by not appearing becomes its own signal. You learn to distinguish deliberation from paralysis. They feel identical from the inside. The network that made you CIO contracts the moment you become CIO. Same process. The people who can speak to you freely, a number fewer than 20. That number will shrink. You sign a $2.2 billion allocation without hesitation. A billion is now a unit. The markets push back. Amber warnings appear on the dashboard. You do not panic. Every move you make is watched by the ministry, by competitors, by markets that have priced you. The chair does not make you permanent. It makes you visible. Those are not the same. Your marriage is now logistics and calendar. You both understand. Neither of you says so. The illusion that you control the market forms. Then the market corrects it. You learn that the market does not care who is in the chair. It never did. Year 1 as CIO closes with no catastrophe. That itself is an achievement. CIO Year 2. A G20 economy enters a sovereign debt crisis. Illiquid, but not insolvent. The market has priced default. The IMF package is 12 weeks from approval. You have $18 billion in dry powder from a rebalancing Thorvald endorsed reluctantly. The rebalancing was approved 6 months prior. 18 billion undeployed. Nobody was comfortable. You run the scenario for 4 days. Every model says the same thing. The country is illiquid, not insolvent. That distinction is worth $6.2 billion. 2.1 billion, first tranche. Sovereign bonds of a country. The market has already been written off. You deploy across 11 trading days, 3 tranches, 6.2 billion total, quietly. Not enough to rescue. Enough to signal permanent capital sees value where the market sees ruin. Other institutional buyers follow. You said nothing. The position said everything. The IMF package finalizes on better terms. The country does not default. Yields reverse. The position marks to market at plus $1.1 billion unrealized, 14 months later. No public statement, no press release. Acknowledging it would require acknowledging what you moved. The mandatory disclosure filing triggers a legal review from the Ministry Council. Expected. Handled. Within mandate, technically, but parliamentary review required. The word technically does the work. The review is structural, not punitive. The question is, are the rules still adequate? The legal opinion arrives. Intervention within mandate. Parliamentary review required. Structural. The next CIO will operate inside a narrower mandate. You made that permanent by demonstrating the edge, by showing what was possible. You made it permanently less possible. That is the reckoning. Year 2 closes. The position holds. The review opens. The rules begin to change. You read the legal opinion on a Tuesday evening. Parliamentary review. Structural, not punitive. You set it down. Markets open in Tokyo in 4 hours. The world does not pause. $1.4 trillion. 9,228 companies across 73 countries. Every one of them opens tomorrow. The liquidity framework assumes no single event requires simultaneous liquidation across 4 asset classes. That assumption has held for 19 years. You are not certain it holds forever. The quant team flags a correlation breakdown in the real assets sleeve at 2017. The pattern reminds you of something. A spreadsheet. Oslo, 11:48 p.m. A smaller life. The scale changed everything, except for the fundamental nature of the risk. That stayed the same. You open a new analysis window. You start building a model the way you always have. Somewhere below you, a junior analyst is running a stress test that will not be resolved until morning. You do not know her name yet. She does not know you exist in any real way. The fund will outlast both of you. It was here before either of you arrived. The capital is permanent. The people are not. That rule never changes. The correlation flag is still open. The model is incomplete, unresolved until morning. Somewhere in the world right now, another crisis is already forming. You will not see it coming. Somewhere below you, in this building, another operator is already rising. Same process. You are powerful, but not safe. The parliamentary review opens in 3 weeks. The game does not end. Every resolution opens the next problem. Always. Tomorrow, the markets open. Indifferent to everything you have built. Patient as geology. Waiting to show you what you still do not know. Tomorrow, you sit back down and begin again.